Hey guys, Mr. T here, just doing a quick solutions video to the Year 12 General Maths Shares practice test. So, starting off, question 1. We got a share listing question here. How many ADLB shares were traded? ADLB is the top row, so we're looking at the volume. And the volume is in 100, so 1838. 2 zeros added. What was the closing price and movement of ADV shares? Closing price and move. So closed at 22 cents. Moved 1 cent from yesterday. What was the closing price of ADLB on the previous day? So ADLB on the previous day, we're looking at the top row now. It moved up 9 cents. So to work out what it was yesterday, I move it down 9 cents to $12.53 minus 0.09. It's going to be $12.44 on previous day. I'll make sure I got my calculator out. Detail the previous year's high-low prices for ADLB. High and low. High was $14.12. Low was $12.15. So you're literally reading these numbers off of the table. There should be gimme marks, yeah? Discuss the buy-sell bids for ADLB by the close of trading. Buy was those two. Buy was $12.53. Sell was $12.60. Calculate the dividend per share paid by ADLB the previous year. So what are we looking at? The yield, 4.63% as a decimal. It's going to be 0.0463, or you can do with it as 4.63 over 100. Working out what 4.63% of the close price was, which was $12.53. 4.63 divided by 100 times by 12.53, 0.58 to 2 decimal points. Div per share. Last year. Describe the transactions and overall trading situation for ADV on this particular day. So when you're doing this, you're just going across and discussing the meaning of all these numbers. Okay? On this day, 18215 with 2 extra zeros. ADV shares were traded. So, of high interest. A lot of people were trading these. Buy bids were 21 cents and sell offers were 22 cents. So we're close, explaining the number of trades. they're quite close to agreeing with each other's prices, so that probably explains why so much was traded. The price closed at, where did it close at? 22 cents. Which is, it's about halfway. About halfway between past year's prices of 33 cents and 9 cents, which might suggest that it's on the way up. Prices rising, something like that. You've touched on all of the numbers, given some context to it. Probably suggested a possible thing happening to the prices here. Okay, so that is page 1 done. Moving on. Toll Holdings has 500 million shares on issue. Net profit of 325 million. We need the P/E ratio, so we need earnings per share. Is going to be $325 million profit divided between the 500 million shares on issue. 325 million divided by 500 is 0.65 cents earnings per share. P/E ratio equals the share price, $18.40, divided by the earnings per share. 18.4 divided by 0.65. You've got a P/E ratio of 28.31 to 2 decimal points. Found the P/E ratio. KS Corp are a transport-based group. Sorry for the cough. I'm a bit sick. Transport-based group like Toll Holdings, but have P/E ratio of 14. Compare the P/E ratios and interpret what they might say about the two companies. So you're just reading off that table in your book. Toll Holdings P/E ratio of 28.31 appears overvalued. K and S Corp P/E ratio of 14. I should have said 28.31 so appears to be overvalued. The 28.31 itself isn't what's overvalued. The P/E ratio suggests that Toll Holding is overvalued, so that's the proper language. K&S Corp's P/E ratio of 14. So appears to be good value. Exactly what it says in the table from your textbook. Why is it reasonable to compare these two companies with the P/E ratio? They are in the same industry of transport. Ash wants to buy 20,000 shares in Aginix for 13 cents each. Should you deal with a broker charging 2% brokerage or trade through the internet with $32 per trade? So pretending he wants to buy. Cons 20 grand times by 0.13. $2,600 consideration. Brokerage 2%, so 0.02 times by 2,600. That's going to be $52. I could answer the question now. That's all I need to answer that question, really. Why is this worth? Well, it's worth 7 marks, so I better show all the work here. GST brokerage of 10% of the brokerage, 0.1 times 52. It's going to be $5.20. 0, 2, 5, 6, 7, 5, 6, 2657 dollars and 20 cents. If it was through the internet, it would be, the internet version would be 2,600 plus 32 plus $3.20. $2,635.20. Therefore, choose internet at $32 brokerage, as it is more than $20 cheaper. Brock sells 1,200 shares in Abacus for $1.88 each and 3,250 shares in Aberdeen for $1.82 each. How much would Brock receive altogether from these transactions? So he's selling Abacus, Cons, 1,200 shares times by $1.88 equals $22.56. Brokerage 0.02 times by 22.56. $45.12. GST 0.1 times by $45.12. This was $4.51. So 2 decimal points. You're subtracting these because it's a cell calculation. So 22.56 minus $45.12 minus $4.51. $22.06.37. Return from selling for that. Aberdeen. Cons is going to be $32.50 times by $1.82. $32.50 times by $1.82. 5,915. Brokerage 2%, 0.02 times by 5,915. $118.30. GST 10% off, $118.30. $11.83. Make sure we take them away again. Take. 5915 take 118.3 take 11.83. That's going to be $5,784.87. Total from the transactions. Total equals 2206.37 plus 5784.87. $7,991.24 altogether. For Brock, that is page 2 done. Page 3, Misty buys 892 Lend-Lease shares for $34.06 each. Unexpected debt forces her to sell them soon after. What's the lowest price you can sell them for and not make a loss? Lowest price you can sell them for and not make a loss, that is the break-even price. So you have two formula, one for when brokerage is percentage, one for when the brokerage is a flat fee. Brokerage is 2% here. So your formula is break-even price when it's percent brokerage is going to be the buying price per share, 34.06, bracket 1 plus 1.1 times by the rate as a decimal, 0.02. All divided by 1 take, 1.1 times by the brokerage rate as a decimal, 0.02. You need to be careful that you use bad maths here. So I'm going to do things separately. 1.1 times by 0.02. Add 1 to that, so it's going to be 34.06 bracket 1.022. The top line, 0.1 times 0.02. The bottom line is going to be 0.978. 34.06 times by 1.022. 34. This calculator screen is really dodgy. Times by 0.022. 34.80932 on 0.978 divided by 0.978. We've got $35.59 to do decimal price. Points, break even price. Next, James bought 82,000 shares, 32 cents each. Notice the share price had risen to 43 cents each after 11 months. His broker advises him to wait for another month before selling. How much better off will he be if he takes his broker's advice? So we're working out how much better off he's going to be by waiting, because the government only taxes half your capital gain if you wait a full year. So we need to work out how much he bought them for by cons 82,000 times by 0.32 equals 26,240. Brokerage, we're adding that. 2% brokerage, 0.02 times by 26,240. $524.80 plus the GST, 10%, 0.1 times by $524.80. It's going to be $52.48. Add them all together. 8, 12, 4, 5, 6, 7, 5, 6, 7, 8, 9, 10, 11, 5, 6, 7, 8, 6, 2, Cost of buying, $26,817.28. Sell. What do we need to find the sell? We need to work out the capital gain. Consideration. He's selling 82,000 at the 43 cents, 0.43 equals 82,000 times 0.43, 35,260. Brokerage, remind myself that I'm taking that 0.02 times by 35,260. I'm going to take away $705.20. Take away the GST, which was 10% of $705.20. That's going to be $70.52. I can't subtract them vertically because there's 3, so I'm going to do it on the calculator. 35,260, take 705.2, take 70.52. That's going to be $34,484.28 for the sell. So the cap gain equals $34,484.28. Take away 26,817.28. It's going to be a nice round number, 7667 cap gain. Now, the initial thing is less than 12 months, so taxable cap gain for less than 12 months is going to be the whole 7667. So cap gains tax for less than 12 months is going to be that whole amount, 7667, times by his marginal tax rate is a decimal of 0.45. So that's going to be $34,450.15. Capital gains tax, so his after-tax return for less than 12 months is going to be 7667, take away the capital gains tax of 3450.15, $4216.85. That's the less than 12 months stuff. Now the taxable cap gain greater than 12 months is going to be half of 7667, or times by 0.5, 0.5 times 7667, $3833.50. So the cap gains tax for greater than 12 months is going to be 3833.50 times 0.45, which is going to be $1,725.08 to 2 decimal points. So the after-tax return greater than 12 months is going to be, this is where some people get fooled. Your capital gain is always 7667, right? You're not taking the capital gains tax off of the taxable capital gain. That's just a made-up number because the government is looking at only half of your capital gain. Your capital gain is still 7667. So 7667 Take away 1725.08. $5,941.92. How much better off? It's asking me how much better off. So I need to compare this number with this number. 5941.92 minus 4216.85. $1,725.07. Better off by waiting. Okay. So that is, I think that's page 3. Yeah, page 3 done. Page 4. Vantech, tech company, share capital 5 million. $1 million, $1, 8% preference shares, 8 million, 50-cent ordinary shares. Profit of 350,000 in 1 year. 55 grand for tax, 35,000 for asset replacement. The rest goes to shareholders. Profit to be distributed to shareholders. Well, you got 350 grand. Sorry. Take away the 55,000. Take away the 35,000. $350 grand. Take 55,000. Take 35,000. You got 260,000 to distribute. Calculate the profit to be distributed to the preference shareholders. So we'll work this out first because they're preferred. So div paid pref shareholders is going to be the number of preference shares, which is 1 million, times by the dividend rate as a decimal, 0.08, times by the par value of $1. 1 million times 0.08 times 1 is going to be 80 grand to pref shareholders. What profit is to be shared by the ordinary shareholders? Well, to know what they get, we need to know what's left over for them. So that was 260 grand to distribute. Take away the 80 grand to the important people. There's 180 grand left for ordinary people. Calculate dividend per share paid to the ordinary shareholders. Well, 180,000 to be separated between 8 million people. $0.0225. So 2.25 cents. As it's shown here, we don't do this anymore, so ignore that. If Annabelle is a shareholder in Vantech with 2,000 preference shares and 5,000 ordinary shares, what dividend will she receive for the preference shares? Well, the thing about preference shares is it's according to the par value. So div paid pref is going to be 2,000 preference shares times by the dividend rate is a decimal, 0.08, times by the par value, which was 1. So 2,000 times by 0.08 times by 1 is going to be 160. Div paid for the ordinary, she has 5,000 ordinary shares, times by the dividend paid per share, which was 2.25 cents. No par value stuff there. He's going to get $112.50 altogether, 160 plus $112.50 $272.50 each. In total. So I think that's page 4. Vantech offer Annabelle the opportunity to reinvest her dividends in shares at a discounted rate. Give 2 reasons why Annabelle might consider taking up the offer and 2 reasons why she might choose not to. So take up, pen, take up, why she might take these up. Cheaper shares. Because of the discount. Plus no brokerage or GST. That's one thing, so it's double discounted basically. Doesn't need the dividend. That's another reason. She might be loaded. She doesn't need that dividend money anyway. And wants more shares in the company is another reason. That's another reason. Don't take up. Reason. Needs the dividend. Or company doing poorly. So doesn't want more shares to offload later. Right. I don't know why I wrote down there. Sorry about that. Vantech. Still hammering Vantech. Vantech announces a 1-for-4 non-renounceable rights issue at $3.85 per share. The market value of the company's shares is $4.25. Wilbur has 4,000 shares in Vantech. How many new shares is Wilbur entitled? He gets 1 for every 4. So we need to work out how many 4s are in 4,000. Which is 1,000 obviously. 1,000 rights for Wilbur. What will it cost Wilbur to take up these rights? Well, he's going to get 1,000 rights. And if he takes up the rights, it's going to cost $3.85. So it's going to be $3,850 to take up those rights. Calculate the expected price on Vantech shares after the rights issue. So, 4 of the old shares, which was $4.25, were worth $4 times 4.25, 17 bucks for existing shares, and then you get 1 at $3.85, 85 for discount share. What is that total? 5.8, $20.85 for 5 shares after the rights issue. So if I want to know the diluted price, I go $20.85, because that's for 5 shares. I divide it by 5, and I get $4.17 expected. $4.17 is the expected diluted price after the rights issue. Paul owns 1853 ordinary shares in BHP, just received his annual dividend, which is paid at a dividend rate of 28 cents per share. Dividend is fully franked. They paid the company tax rate of 30%. Paul's marginal rate is 47%. Calculate the franked amount and hence the imputation credit. Well, they're fully franked. He's got 1853 shares at 28 cents per share. So much like your DI, there's no franked and unfranked amount, it's just his dividend paid. $518.84. Then the imputation credit is going to be that amount, $518.84, times by 30 over 70, times by the franking rate as a decimal. Don't be confused by this. This is trying to misdirect you. The company tax rate in Australia is 30%. This is what's important. It's fully franked. So 100% as a decimal is going to be 1. So times 30 over 70, you're going to get $222.36. Imputation credit. Calculate the tax owing. Well, income declared is going to be the dividend amount, $518.84, plus the imputation credit, comes to $741.20. Tax liability is that times by his marginal tax rate as a decimal, 0.47. So $348.36 to 2 decimal points. Tax owing is going to be that last number, tax liability, minus the imputation credit, so 222.36, which is credit that you're sent for the tax the company has already paid because it's fully franked. So 348.36 take 222.36. Oops, sorry, $126. Tax owing. Okay. I think that's page 5 done. Page 6, graphs. The chart below shows the performance of Harvey Norman shares against the ASX 200 over the past 9 months. So if I look at this, Harvey Norman's the daily share price, red. The blue is the All Odds Index. No, sorry, the ASX 200, not the All Odds Index, ASX 200. And then Harvey Norman, we've got a moving average here. Identify one buying opportunity by circling on the diagram. Explain why this might have been a good time to buy. We're not going to get any buy or sell signals here because you don't have 2 moving averages for the same company. What you do have is bullish and bearish signals. So when the share price crosses up over the moving average, so we have, you got one there, bullish signal. So that's late December 2013, good time to buy. As share price crossed up through moving average, which is a bullish signal. Compare the performance of Harvey Norman shares against the ASX 200. They follow each other pretty closely here. The overall pattern is the same. But in this situation at the start, they follow the same pattern, but Harvey Norman is quite a bit separate there. So I'll talk about those things. Overall, HVN follows trends in ASX 200. However, it outperformed ASX 200 September to, let's just say October. It doesn't go all the way to November here. It sort of stops there. September to October of 2013. What else could I mention? I've got 3 marks here. Overall trends, 1 mark. Outperformed, 2 marks. The only thing I could probably comment on is that even though they did follow the same pattern, Harvey Norman didn't drop quite so much in both of these dips, December and February. And it also went a bit further in the peak in January of 2014. Also in the ASX 200 falls late 2013, early 2014. HVN did not fall as far and also rose higher in January 2014. So overall, while I'm saying that the patterns are quite similar, Harvey Norman was above for this period. When there was a fall, it didn't fall so far. It didn't fall so far here, and also when there was a jump, it jumped a bit further. So I think that is page 6 done. Page 7, use evidence from the chart to explain the current performance of HVN shares. Would you recommend buying shares in this company? Give reasons for your answer. Sorry about that. Well, you can argue this many different ways. If I look at the diagram there, Harvey Norman seems to follow ASX 200 closely at end of graph. It has just crossed down through the moving average, so just had a bearish signal. So I would say do not buy. Mainly based on that signal at the end, but it's sort of flattened out. It's not doing anything spectacular compared to the ASX 200. Alright, as an investor, Ellie has developed a share portfolio including 4250 shares, so there's a bunch of information here. That's all in the table already. Ellie has checked the ASX website today and the market value of ANZ shares has decreased by 1%. Okay, so it's not telling you, except for Billabong, which has stayed static at 17.22. Everything else has changed in price by percentage, so we need to do some extra maths here. So, ANZ shares decreased by 1%. I'll do the maths for ANZ up here. If something decreased by 1%, it's now 99% of what it was. So 99% as a decimal, 0.99 times by ANZ's price, which was $28.95. Get the calculator, 0.99 times $28.95. So it's going to be $28.66 to 2DP in day 2. Billabong remains static at 17. So I can put that. Billabong stayed static, 17.22. Harvey Norman decreased by 2.1%. So if it's gone down 2%, it's 0.98, 98%. It's going to be 0.9. It's going to be 97.9. So Harvey Norman, where could we do that maths? Harvey Norman, 0.979. 97.9% is 100. Take 2.1 times by $4.86. 0.979 times $4.86. 4.76 to 2DP. And AGL increased their value by 3%. Something increased by 3%, that's going to be 103%, so 1.03 times by $14.88. It's going to be 15.33 to 2DP. So I know the prices now. Okay, the values. So you're going to go this times by this, this times by this, this times by this, this times by this. To get the values at day 1, $42.50 times by $28.95. $123,037.50. 3375 times by 17.22. $58,117.50. Because they stayed the same, it's also going to be $58,117.50 here. 12,250 times by $4.86. 59,535. 1,500 times by 14.88. 1,500 times by 14.88. 22,320. The other value column for day 2. So it's going to be $42.50, but now times by $28.66. We're going to jump over there. $42.50 times 28.66. 121,805. That one's already done. 12,250 times by 4.76. 58310. 1,500 times by $15.33. 22,995. Now we have to add all that together. It's quite labor intensive, isn't it? 123,037.5 plus 58,117.5 plus 59,535 plus 22,320. 26,3010. Last column, AMV 121,805 plus 58,117.5 plus 58,310 plus 22,995. $261,227.50. Oh, sorry. So those are AMV1, AMV2 done. Calculate the index on day 2. Given that the index had a value, so it's given this arbitrary score of 1,500. So like I've taught in the lessons, you want to find the percentage change between these two and then apply that to the score. That's a better way than doing that weird formula in the book, but you end up getting the same answer anyway. Percent change is the index of the second time. Take away the index of the first time over the index of the first time, times that by 100%. Take 263010 divided by 263010 times by 100. We get negative 0.68 to 2 decimal points percent. So 0.68 has a decimal, 0.0068, times that by the arbitrary score given, which was 1,500. 0.0068 times by 1500, 10.2. So that's telling us the decrease that it underwent. So now I can go 1500, take 10.2. 1489.8 points on day 2. Find the percentage increase or decrease in the index from day 1 to day 2. Well, we already did that. It's here. So negative 0.68% to 2 decimal points. So 0.68% decrease. That's what it's asking for there. Just be careful. Increase or decrease. That's that page done. Last page. Consider that the consumer price index was 97.2 when the shares initially purchased, currently 102.8. Real growth question. So what is the percent change, or what is inflation according to CPI? Equals. It was, so the second number is 102.8. Take 97.2 over the original number, 97.2, times by 100%. 2.8, take 97.2, divided by 97.2, times by 100, add a percent sign, 5.76% to 2 decimal points. So, therefore, no real growth. Portfolio dropped by 0.68%. Inflation was 5.76%. So loss made even worse by inflation. Only AGL showed any growth from day 1 to day 2. Using the day 1 and day 2 information for the table, calculate the cost of buying the AGL shares on day 1. So we've got a buying calculation. Cons. AGL, you had 1,500 of the shares, times by $14.88 equals 1,500 times by 14.88, 22,320. Brokerage assumes 1.5% brokerage, so 0.015 times by 22,320 times by 0.015, $334.80. GST, 10% of the brokerage, 0.1 times by 334.8. It's going to be $33.48. Buying, so I can add them vertically, 8, 12, 4, 5, 6, 7, 8, 6, 7, 8, 6, 2, 2, $22,688.28. Index the cost of buying AGL shares on day 1 for inflation. So, indexed cost is going to be the original cost, 22,688.28 times by 1 plus the inflation rate as a decimal. The inflation rate was 5.76%, so 0.0576 to the power of the number of years of inflation. It was only 1 year, so to the power of that. So it's going to be 22688.28 times by 1.0576. 22,688.28 times by 1.0576 23995.12 to 2 decimal points. Calculate the proceeds from selling. Sell calculation, cons. She sold them on day 2, 1,500 times by, the price went up to $15.33 equals 1,500 times by 15.33, 22995 minus the brokerage, which was 0.015 times by 22,995. $344.93 to 2DP. Take the GST, 10% of $344.93. It's going to be $34.49. Subtraction, so I need to do on the calculator, 22995. Take 344.93. Calculator, jeez. 22995. Take 344.93. Take 34.49. $22,615.58. And what do we have at the end? What's the real rate of return? So that's a TVM solver question. Apps, finance, TVM solver. N is the number of years, it was 1. I% is what we're working out, so put a star next to that. PV is negative, the indexed value of the cost of buying, so 23995.12. PMT is left as 0. FV is the return from selling, $22,615.58. PY and CY are both left at 1. So plug those numbers in. 1, negative 23995.12, 22615.58. Alpha solve. I get negative 5.75 to 2 decimal points. So therefore, real rate of return on the AGL shares is negative 5.75% per annum, considering inflation. So even though the AGL shares increased in price and you should have made a profit from selling the shares, because inflation was so high, the price of everything was going up so much over that same time, that profit is sort of overridden by the fact that this calculation here is telling you that the inflated price of buying the shares would have been $23995.12, which is actually higher than the return you would have got from selling the shares anyway. So yeah, you're making a 5.75% loss in real terms, considering inflation on that investment. And I think, yeah, that's page 8. So that's the end of the shares practice test. Hopefully those solutions help you out. And I'll see you on the next video.